Welcome to the deep dive. Today, our focus is squarely on Spok Holdings, that's SPOK, and their really critical Q3 2025 earnings call reported back in late July.
Right.
Now, for those of you tracking this company, you know they're in the middle of this massive multi-year transition.
It's huge.
Yeah, and this call felt like, well, the ultimate checkpoint. Our mission today is to really distill the key numbers and the strategic narrative that, drove that immediate, sharp, positive move in the stock right after the call.
That's really the core challenge here, isn't it? Spok is, they're juggling two things. Managing the sunsetting of their legacy wireless paging business.
The old guard.
Exactly. While trying to simultaneously build and scale up this modern, unified healthcare communications software platform. So this quarter wasn't just about hitting the numbers.
Yeah.
It was really about validating that the whole pivot, the software transition, is actually generating durable growth. And crucially, that this growth engine is finally firing with enough force to outrun that legacy headwind.
Okay, so where did all that immediate optimism come from? Let's kick off with the headline financial results, the ones that clearly gave the market that immediate vote of confidence.
It was a pretty decisive beat.
It really was, a decisive beat across the board, which, let's be honest, is exactly what a transition story like this needs.
Absolutely.
So they reported GAAP EPS of $0.22. That was significantly ahead of the street's dear $1.18 consensus.
A solid beat there.
And revenue landed at $35.69 million. Again, topping the $35.0 million consensus estimate, and importantly, marking a pretty strong 5% growth year over year.
Yeah, and what's fascinating there, I think, is that the beat wasn't just, incremental. It strongly suggests that the higher margin software mix is starting to pull through the headline totals maybe sooner than some folks anticipated.
That makes sense.
And we saw that reflected in adjusted EBITDA too. It hit $7.49 million, up 6% year over year. Now, for a company undergoing this kind of significant capital-intensive shift,
You're right.
Confirming that profitability trajectory, stripping out the accounting noise is just absolutely crucial.
And the market reacted?
Oh, yeah. That confirmation directly led to the stock seeing that strong jump, 7.7% in the trading session right after the report.
Okay, so let's look under the hood then, because as you said, SPOK is effectively two distinct businesses running side by side right now.
Correct.
We need to dissect the software side, that's the growth story, and then the wireless side, which is more the legacy cash cow. Where did the real fuel for that 7.7% jump actually come from?
Well, it's unequivocally coming from the software bookings. That's the headline within the headline.
Okay.
Software operations bookings hit $11.7 million this quarter. Now, that represents a really robust 34% year-over-year increase.
34%.
That's the figure institutional investors are going to highlight first because it demonstrates accelerating success in winning new business. It's the forward indicator.
34% growth sounds fantastic, absolutely.
Yep.
But let's be realistic for a second. What was the base that was growing from? And more importantly, does this booking strength really translate into actual, durable revenue visibility down the line?
It absolutely does. And that's the key connection. The booking strength provided really clear visibility, pushing the total software backlog up 19% year over year.
19% backlog growth?
Yeah, to $65.2 million. And this backlog figure, that's the definitive proof point. It shows that long-term revenue commitment from their large enterprise customers, primarily those big healthcare systems, that's stickiness.
Okay, that brings us neatly then to the biggest structural challenge. The wireless side, the legacy business. How are they managing that secular decline while still trying to fund all this software growth?
They're managing it extremely deliberately. Look, the decline in the number of pager units continues. That's inevitable. It's that sunsetting technology.
Right.
But they are stabilizing the financial impact through really smart pricing actions. Wireless average revenue per unit, ARPU.
The key metric there.
That improved about 5% year over year. And furthermore, they actually noted a sequential improvement in net unit churn.
Okay, so churn is slowing down.
Exactly.
Yeah.
Which means they are losing those legacy customers at a measurably slower pace. It's about stemming the bleed, essentially, and giving the software side more time to catch up and take over.
And that stability, presumably in the wireless cash flow, translates directly into having a very flexible financial foundation overall.
Precisely. Look, they declared a 0.3125 sumless pounds per share quarterly dividend again.
Consistent.
Very consistent. They maintained strong cash balances, ended the quarter with $21.4 million, and this is critical, zero debt.
Zero debt is always nice to see.
Especially in a transition. The CEO's core message here remains really consistent. Generate cash, return capital to shareholders, but do it while responsibly investing in the growth engine, which is software.
And they have a history of that capital return.
They do. They made a point of noting they've returned over $720 million to stockholders over the last 20 years. So you have consistency, a debt-free balance sheet that provides a significant buffer during this kind of pivot.
I see the historical track record, definitely. But does that aggressive capital return strategy, the dividend, potentially conflict with the R&D investment?
Yeah.
They really need to truly accelerate the Care Connect platform. Is there a risk they're prioritizing shareholders today over necessary platform acceleration for tomorrow?
That's the balancing act. But management's forward outlook, their guidance, suggests they believe they can actually do both.
Okay, so let's shift to guidance then. They must have felt confident enough in those bookings and that backlog to adjust the outlook.
They did. They raised the top end of the full-year outlook for 2025.
What are the new numbers?
So they raised the FY25 total revenue outlook to a range of $138.0 million to $143.5 million. Now, while they reaffirmed the adjusted EBITDA range that stayed at $28.5 to $32.5 million, the midpoint of that revenue guidance clearly implies the mix shift is accelerating.
Right, more software, less wireless in the total.
Exactly. If you unpack the midpoint, we're looking at anticipated software revenue growth of approximately 6.4% for the full year.
6.4%.
Which is expected to offset that slight managed decline in wireless revenue.
Yeah.
That 6.4% software growth figure, that's really the number we need to track closely going forward. That's the engine.
Okay, now here's where, for me, it gets really interesting. The strategic focus on the integrated Spok Care Connect platform. They aren't just selling, individual software tools here and there. They're really pitching this unified ecosystem.
Yeah, Care Connect is absolutely the centerpiece, and it's also the moat builder for them.
How so?
Well, it integrates secure messaging, directory services, on-call scheduling, all these critical hospital workflows. Spok is successfully positioning this thing as the necessary unified clinical communications hub that major hospitals need, not just for efficiency, but also for, regulatory compliance.
That deep integration sounds like what makes it sticky.
That's the goal, make it indispensable.
And are we seeing traction in those sticky recurring revenue streams then? I was pretty impressed by the claims of triple-digit year-over-year growth in managed services revenue. But tell me, is this coming off a tiny, tiny base? Or is this truly starting to move the needle with those big enterprise customers?
Well, honestly, it's a bit of both right now.
Yeah.
It was coming off a relatively small base compared to, say, license revenue.
Okay.
But the fact that managed services are gaining traction specifically with large enterprise customers is a crucial leading indicator. This highly recurring revenue stream, that's exactly what investors are looking for to smooth out the inherent lumpiness you get with big one-off license deals.
Speaking of lumpiness, how did management handle the inevitable questions about that pretty steep decline we saw in license revenue this quarter, especially coming off what they called an exceptional Q2?
Yeah, they addressed it head on, which was good. Management acknowledged that license revenue is inherently choppy. It just is, especially when you're dealing with large enterprise customers and complex implementations.
Makes sense.
They basically noted Q2 was exceptional, partly because they managed to pull some contracts forward into that quarter. Q3, conversely, saw some typical summer seasonality, which pushed some large deals out into Q4.
So timing shifts, basically.
Pretty much. But they remain highly bullish. They asserted the pipeline is robust and that they fully expect a strong fourth quarter to deliver on that reaffirmed guidance.
Okay, but that confidence needs to be backed up by continued investment, right?
Yeah.
What does the R&D budget look like going into 2026? Are they putting their money where their mouth is?
It looks like it. They plan to slightly increase R&D investment. The plan is aiming for over $13 million in 2026, which is up from approximately $12 million this year.
And that's focused on Care Connect.
Yes, directly targeted at Care Connect enhancements, adding functionality. The clear anticipation is that those investments will translate directly into greater success winning new logos and also driving platform upgrades across their deep existing installed base, starting in 2026. Now, if we sort of connect all this to the bigger picture, the stock market view.
Yeah.
What really stands out is this divergence we're seeing.
Explain that.
Well, despite the solid Q3 beat, despite that immediate 7.7% jump post-earnings, Spok's longer-term total return, say over the last year, has significantly lagged the broader healthcare ETF XLV.
Which has been roughly flat, right?
Exactly. Spok is down significantly over that same period, about 20.75% over the year, and even worse over the last 3 months, down around 23%.
So that's the core tension, isn't it? For anyone tracking the stock, the market seems to be valuing this company like it's purely a legacy communications business facing inevitable decline.
Right, pricing in the wireless headwind heavily.
Yet the core software operation, the growth engine, is showing that 34% bookings growth we talked about. It's like two different companies and one stock price.
Precisely. And this raises the really important question. Can that sustained growth in software bookings and now the traction in managed services, can that whole growth narrative actually outpace the structural decay of the wireless business fast enough?
Fast enough to warrant a multiple re-rating.
Exactly. A multiple expansion off these current, arguably depressed small-cap healthcare valuation levels. Their success in converting those big hospital systems, they cite having 9 of the top 10 children's hospitals, 18 of the top 20 adult hospitals converting them fully onto the Care Connect platform, is the absolute key to unlocking that expansion.
Okay. So boiling it down, the key catalysts for investors to watch for the second half of 2025 are pretty clear then.
I think so. First, solid execution against that raised guidance, particularly in Q4, they need to deliver.
Makes sense.
Second, the continued cadence of those multi-year software deals, and critically, the managed services bookings growth. Need to see that momentum continue.
And third,
successful new deployments of the fully integrated Care Connect platform, showing that the big vision is landing with customers.
Okay. This brings us neatly to our final segment. And, as always, a mandatory disclaimer here. What we are about to discuss is purely a thought experiment. It's based on the information provided in the earnings call materials we've just gone through.
Absolutely. This is not financial advice.
We are definitely not recommending you buy or sell any security. Please do your own research.
Right. With that very necessary context, let's pitch an outrageous but plausible trade idea, one that's built directly on the central strategic themes we've just unpacked from this call.
I'm intrigued. Lay it on us.
Okay, the core thesis is this. A long-term, potentially leveraged approach that bets on that software multiple expansion we just discussed, while simultaneously harvesting the pretty strong dividend yield the stock throws off.
Okay, interesting combination. Betting on growth while collecting income. But how do you structure a leveraged bet on a stock that still carries that obvious legacy risk from the wireless side?
Well, the rationale really hinges on the stability of that legacy business.
Yeah.
Yes, the wireless side is structurally declining, we know that. But it seems stable enough thanks to those ARPU improvements and really tight expense management they talked about.
Right, slowing the bleed.
Exactly.
Yeah.
It's stable enough to generate significant and seemingly reliable cash flow. And that cash flow is currently more than sufficient to cover the strong quarterly dividend. So our argument, or the thought experiment, is that the market might be mispricing the stock right now.
How so?
Viewing it too much like a value trap purely because of the wireless decline, when that confirmed 34% software bookings growth actually suggests there might be a deep value technology play hiding in plain sight here.
Okay, so if an investor bought into that thesis, how could they theoretically play that specific transition?
One way, again, not advice, just an idea, is to initiate a long-dated call spread, say 12 to 18 months out.
Explain a call spread quickly.
Sure. A call spread means you're simultaneously buying a call option at one strike price and selling another call option at a higher strike price, both with the same expiration date.
Okay.
This structure lets you make a leveraged bet on a defined upward move in the stock price. You're essentially betting it will rise, but capping your potential upside and significantly reducing your initial cost compared to just buying a call outright. You'd aim for strikes that capture a move back towards, say, its 52-week high range.
And where does the dividend fit in?
Well, you could conceptually use the strong quarterly dividend yield you receive from holding the stock, or just factor it into your overall return expectation to help finance part of the net cost, the risk premium of putting on that option spread.
I see. So you're sort of using the cash flow from the legacy business to help fund a bet on the future growth story, potentially capturing that shift in market perception from value trap to a legitimate small cap software growth company.
That's the essence of the outrageous but plausible idea, yes. Capitalizing on that potential perception shift.
That is a compelling way to think about using the legacy cash flow to actually fund the acceleration of the growth narrative, at least from a trading perspective. Okay, fascinating stuff. So just to recap the core takeaway from today's deep dive, Spok Holdings appears to be demonstrating really credible execution in its vital software-led mix shift. We see that evidenced by the strong bookings and growing backlog and that raised guidance.
Yeah, and they seem to be successfully managing that legacy wireless headwind, the thing that has arguably plagued the stock price perception for years now.
Definitely.
And maybe here's a final provocative thought for you, the listener, to consider as we wrap up. Does the market fully appreciate that Spok's legacy paging network, the thing often just called the headwind, is now being seamlessly integrated into the Care Connect software platform?
Interesting point.
And could that integration actually serve as a vital, high-reliability differentiator? I mean, think about it. It's a communication channel that cellular networks simply cannot match for critical life-and-death hospital operations where reliability is paramount.
So, is the wireless segment often seen just as a liability dragging down the valuation?
Actually, in some ways, a durable competitive moat, protecting their market share in the most critical communication spaces within those hospitals. Something to mull over.
That is a great question to explore further. Thank you for joining us on this deep dive today. Just a reminder, all the information we discussed was derived solely from Spok Holdings Q3 2025 earnings materials and related public investor context. We definitely encourage you to explore the source material further yourself.